Hello and welcome to this week's episode for SPY Trader Now. I am your host, my name is Ken, and our model portfolio is up 33.29% year to date. We have a yellow for the stock market strength color signal. Our whole goal here at SPY Trader Now is to beat the returns of the S&P 500 buy and hold investor. Their portfolio is up 17.12% year to date, and we are up 33.29%. So we are very happy that we are beating them by more than 5%, and we are very happy that we are in the triple digits year to date. Today's video is going to be what I refer to as an intra-month video as opposed to an end-of-month video. So it's going to be shortened content to try to get through this video as quickly as humanly possible. This video is for retail investors and traders who want to beat the market. We do a deep dive into technical analysis for the S&P 500. Not only do we do the technical analysis, but we show you exactly how we trade our model portfolio to share with you how we produce our decisions. This is what sets us apart from a lot of other people out there that show you the charts and give you opinions, but they don't show you exactly how they would trade those opinions, which is really critical when you want to invest in the market to determine how much risk of the portfolio. And there's a lot of different dynamics, more than just showing you the charts. So that's why we want to give you a little bit more effort here at this channel. We're going to review last week's trades. We're going to go over the chart of the portfolio equity curve compared to the benchmark, the S&P 500. We're going to show you the CNN Business Fear and Greed Index, go over seasonality, and then at the end of the video have market summation, closing thoughts, and next trades. Last week, the S&P 500 lost 0.59%. This here is a weekly 5-year duration candlestick chart for the S&P 500. This is where we are at right now, and this is here in the thumbnail, but let's focus over here on this section of the chart right now where we are currently at. You have this blue line here which represents a resistance. You have this pink line here which represents support. You put the two lines together and what that comes up with is what's referred to as a bearish rising wedge. Now I put this blue line here as a representation of, on the rising wedge formation, the distance from here to here is the distance from here to here. If we were to start breaking down at that point, a lot of arrows, let me clean that up. Now, so this blue represents the potential of how much this market could fall if it's going to go the full duration of when I see this rising wedge starting. That's approximately a 10% decline, taking us down to 540. We haven't even broken the pink line yet. And I'm afraid that we're going to have a gap down as early as next week. So with that, I am planning on exiting the market on Monday when the market opens up. And I'll give you that in my closing thoughts. But I'm going to tell you right now that I do believe that this is going to happen, as opposed to, I guess the other options are moving sideways or going up even at a higher trajectory. Now, of course, we could move sideways, and I could be completely wrong, and this market could continue to go up, but it will go up at greater risk. And the question is how much risk do you want to take on? This, when you're managing your money, it's a risk to reward ratio is the whole game. We're not just investing in stocks or the stock market. We're prioritizing our risk, how much risk we want to put on the table. And that's what we're trying to do here. Okay. Now, what else do you have going on here? Now, I talked a long time about a negative divergence, and then we saw that it was breaking out above that negative divergence. Now, the first negative divergence was from that peak to that peak. When you take those two peaks and you draw that straight line, yes, indeed, we did break out. Well, I have since redrawn this to this new line here on the MACD, not taking this top into consideration, but taking that top into consideration, look at that MACD, how it looks like it's definitely flattening out, losing its angle, and it potentially could just come straight down, meaning that that will be a new peak. Now, if that's true, and I take the distance from that peak to that peak and draw that line right there, well, then that's where you come up with this line right here. We have another weekly negative divergence. When you compare that against the price action, price is going up, MACD is going down, negative divergence. So this negative divergence can very likely come to the end by this 10% decline in the S&P 500. It has not happened yet. We have seasonality on our side. Market is held up remarkably well, unbelievably well. But I'm thinking that on a risk to reward ratio, the risk of this actually happening compared to the potential reward is simply not there. Last week, we sent out 2 trades to our subscribers. Now, let's go over the trades in great detail. The first trade was on Monday, December 9th. Now, if you remember last week's video, I told you guys flat out, I don't like this market. I want to exit the cash. Well, guess what? At 7:42 a.m. Pacific Standard Time, that's exactly what I did. We want to close all our positions, buy to close the 2 in the money covered calls, and also that had a 6:05 strike, 12/13/24 expiration at $3.55. And we want to sell all 200 shares for about $605.99. Then on Wednesday, December 11th at 8 a.m., I sent out this trade alert. 12/11/24, buy 200 shares of SPY at the market, which at that time was about 606.77 per share, which is about 91% of the portfolio going long. And here's the exact trade right here on the Think or Swim platform. So we put $121,000 at risk. Now I'm going to show you the next slide to show you why I did that. Okay, now we are looking at a 10-day candlestick chart. So this here is Friday, Thursday, Wednesday, Tuesday, and Monday, December 9th, okay? Now, on Monday, December 9th, there it is, close all my positions. I made that decision based upon what I saw on Friday's action the last week of the week prior to that. And you can see the big red candlestick that we had moving down during that time frame. This line here represents approximately the price when I made that decision, sent out that trade alert. So the very next day, the market drops. Bam, we went down. But then the very next day after that, bam, we shoot up and then gap up just like that. And that was due to the economic news that came out. Now, let me show you what that news was. So this is the economic data that came out on Wednesday, December 11th. You had the CPI, that's the Consumer Price Index. And you can see here core inflation and some inflationary information month over month, year over year. Then we're going to look at the actual readings that came out. We're going to compare that against the consensus. And generally speaking, on the CPI, 315 was the consensus and 315 was the actual. And what's important a lot of times is not what the number is, but how the market reacts to the number. That is the important thing that you want to take into consideration. So how did the market react? We already know that the market reacted with this massive pop up. And at that point in time, I was like, this particular day on Tuesday, December 10th, that day looked like a bottom. And I'll show you that in the charts coming up. So when I saw this thing pop up like that, I thought I want to be long this market. I don't want to be sitting on the sidelines. So I took on 200 shares. No options, just 200 shares naked, and let's just see what happens. Well, look what happens on the next 2 days. You get absolutely zero follow through. You get a red candle followed by another red candle. Not good. So I did put some money at risk here. I was thinking that we were going to get some follow through to the upside. Did not happen. So we still currently hold those 200 shares of SPY. All right, now here are some of the trades that we've made in 2024. If you want to see all my trades going back for the last 3 years, you can head over to this link. It will be down in the description down below. Now, let's go over what's happening right now. On the 9th is when I closed out 2 transactions. Now, on those 2 transactions, I had shares. I had 200 shares of SPY. I referred to it here as stock, although it's not technically stock. It's an ETF, electronically traded fund, treated like a stock as opposed to a mutual fund. Now, on that particular transaction, I lost $410, but I also had an in-the-money covered call, and lo and behold, I was profitable in that position by $448. So we had a small gain when everything was washed out. But at that point in time, I was happy to be sitting in cash. I wanted the portfolio to be safe. Then, as I told you guys, on the 11th, Wednesday the 11th, I took on those 200 shares. There's the purchase price. We currently hold them. So the yellow represents open positions. And right now we're upside down $500 in that position. If you want to see how I do this every single week and watch the model portfolio, I want you to hit that like button down, subscribe to my channel, and ring that bell. Thank you. Now we are looking at an equity curve of our model portfolio in blue compared to the benchmark of the S&P 500 in pink. And you can see that we are beating them. We are doing great. No complaints here with this portfolio. Okay, now we are looking at a 6-month chart candlestick for SPY, spiders. And this is that day that I was telling you about that I thought was a low. And you know, I do cycle brackets and I look at cycle patterns and I kind of see things like this. I see the market coming up, dips in, comes up, dips down, comes up, dips down, comes up, dips down, comes up. But we got no follow through on that last set of what was happening. So if that was a low similar to that low, I was looking for that follow through. We did not get that follow through. So I just like, and also look at my cycle brackets here. This low represents that low, this low, that low, this low, that low, this low, that low. I thought this low was going to represent that low right there, be completely in line with my cycle brackets. But we did not get any follow through here. And I was looking, and not only that, I also have on here a valid trend line. So I have a couple valid trend lines. This lower valid trend line representing that low and that low right there. Then as the market began to advance at a steeper angle, I grabbed that low right there and drew this other valid trend line. We are now trading below that second valid trend line. Take it for granted that is a steeper valid trend line. Is this a blow off top? Are we going to start crashing down? Are we going to move sideways and then go up? It's really unclear right now. The market is an 800-pound gorilla. It's going to do whatever it wants to do. But when I look at it from a risk to reward ratio, this red line right here represents the distance from this lower trend line to this upper resistance line right here. So we could absolutely fall down that much, taking us down into the 575 area. Very reasonable thing that this market could easily do. So I don't want to be caught long during that time frame. I also don't want to go short right now because the market's just too bullish. Anybody who's gone short during this time frame is absolutely losing money. So it's not like I want to be long, and it's not like I want to be short either. What else do we see on this chart? We have the MACD below its signal line, slow stochastics below its signal line, heading south, heading south. These signs are bearish to me. Now we're looking at a ratio chart. This is the NASDAQ 100 against the S&P 500. And the ratio chart is the one that is in red and black. We also have in blue the S&P 500, blue right there. And black, we have the NASDAQ 100, black right there. And it's a representation of risk on and risk off. When the market travels north, that's risk on. When the market travels south, that's risk off. Well, where are we at? we are risk on with a vengeance. I also have on here a couple of moving averages. I've got the 10-day moving average in red and the 50-day in green. And this ratio chart has smoked past the 50 and the 10 and just gone straight up. So that is an unbelievable bounce for a short period of time. So where are we headed right now? Down here on the MACD, I've got supports on the MACD and I got resistances here. We have a very short distance from the current location to tag that blue line right there and basically start coming down. When that happens, when and if that happens, the ratio chart is going to be traveling down. And if that were to happen, then the NASDAQ 100 and the S&P 500 most likely are going to be heading south as well. So at this point in time, it has been bullish, but the trajectory is unsustainably steep, meaning that at some point this is going to be crashing down. We just don't know if it's going to be on Monday, Wednesday, or who knows exactly when. This thing could continue to go higher and then come down, but eventually it will come down. We just don't know exactly when. We haven't seen the signs yet. But on a risk to reward ratio, I say the risk at this juncture is not worth it. Now we're looking at the VIX, which is the Volatility Fear Index. 3 ranges. Below this green line, bullish. Above this green line, bearish. Below this lower green line is the ultra low range, bullish. We're in the ultra low range. So, and we've spent an enormous amount of time here in the past 1 year, and we're still here right now. So from this chart here, we are in a bullish configuration. We are in the ultra low range. The MACD is above its signal line, but it's nothing to really too concerning here, although it is coming from a low level, giving it plenty of energy to come up. Slow stochastics is just crossed above 20, above its signal line, and it looks like it's pointing north. If that were to happen, and if the VIX starts to climb, well, the S&P 500, which is here in blue, that's going to start to decline. Okay, now we are looking at Warren Buffett, the Oracle of Omaha, and we have over here CNN Business Fear and Greed Index. Currently, we are in neutral. Now, we want to compare that to the 1 week ago number, 52, and we dropped to 50, which is kind of amazing that in this kind of an environment, you don't see this needle progressing this way, but you don't see that yet. You've got investors taking pause here on exactly what I'm talking about, risk to reward ratio. Now we are going to look at seasonality. And on seasonality, what we are saying is that for the month of December, that's the current month that we're in right now, going back 5 years, 75% probability that you're going to close the month higher than when you opened it. The current month of December is up 0.28%. So we have at risk only 0.27% at risk. Look at that monthly candle for December. It's like flat as a pancake. So there's a 75% probability by the end of the month you're going to be higher. Now today's, as I'm filming this, it's December 14th. We're halfway through the month. So we could come down and then come back up, but ultimately at the end of the month, we should be in the positive territory. There's a 75% probability that you are going to be bullish. The only thing we don't know is what's going to happen between now and then. And then they all talk about the Santa rally. So as we get closer to December 25th, you get that Santa rally, or theoretically you get that Santa rally on a seasonality basis. That's your 75% probabilities right there, for your Santa rally. So far, this market has done very little, 0.28% year to date. So from a seasonality basis, I would say that we're bullish. Okay, now we are looking at a 3-year weekly candlestick chart on the Thinkorswim platform. And in here we have standard deviations in gold, +2, -2 in gold, +1, -1 in pink. The regression 50% line is in dashed green. Here you can see that rising wedge formation, and you can see that steeper angle of ascent that we're starting to get into. I have in here a couple of alerts, one at 610, and I've got a lower alert set up at 586, just to see when this market starts dropping or advancing. And I got it real close, because this upper resistance line is also really tagging the +1 standard deviation. Now, just in case you don't know anything about standard deviations, normally speaking, there's a 68% probability that you're going to trade between the +1 and -1 standard deviation. 68%. So once you go above that, your risk to reward ratio is now really working against you, because there's higher risk that it's going to pull back into the medium, which is this dashed green line right here. Okay, so with that said, we want to know what is going to be happening here. Well, we are absolutely advancing. It looks like we're hitting this resistance upper line here. So the question is are we going to get one of these right here where we're going to start pulling back like that? It certainly would not be, no one would say that that was out of the ordinary if that were to happen, especially looking at this chart right here. I mean, otherwise you're going to, what are your options? Otherwise you're going to move sideways or move up. I say the higher probability is that you're going to start to traject down like that. Okay, so that's what this chart. Now let's switch over, and we're going to go to a 1-year daily, change our cycle brackets to daily, 1-year daily. Got a few things going on in here. Let's pull that down so you can see this really nice. Okay, now I also have in here a Fibonacci, the Fibonacci extension that I have drawn in right here. And you can see that we pretty much tagged the 78.6% Fibonacci extension right there. But what I want to do is I want to take that Fibonacci extension and I want to remove it. So you don't even see that Fibonacci extension. Now, another thing that I have in here is I've got in here positive cycle, neutral, and positive. What do I mean by that? Let me show you what I mean by that. So let's start with this one right here, this positive cycle. You have a low and you have a higher low. You have a cycle that came up, made a peak, and then came crashing down. That is a positive cycle. Same thing, you're following that by another positive cycle. Now we come up here and we came down pretty much neutral cycle, followed by a positive cycle with a low right there, followed by this. Now, was that the low that I identified right there on Tuesday? That is what I was thinking, that we had a low established there on Tuesday, but we've gotten no follow through. It's moving sideways since then. So that's kind of what's happening right now. If that is the cycle, the next cycle low of the current cycle, and it very well could be. I need some more candles in order to make that determination. But it also is very possible that that is not the low, and we are going to just start coming down, and there'll be some new established, some new low, maybe established at the 586 level, which is right around this cycle low right here, taking this current cycle to a neutral cycle. Now here, you have a negative cycle, because we came up and we came down all the way to there, and that is a lower low that this market made. Not an equal low, but a lower low. And in that case, that is a negative cycle. Now, also on this chart, you can also see that we've got the slow stochastics below its signal line, MACD below its signal line, heading south. I see bearish characteristics here on this chart. Now I want to show you guys a spreadsheet that I created in order to determine the strength of various asset classes as well as the 11 S&P 500 sectors. Now let's start with the asset classes. We want to compare the current week's reading 39 compared to last week's reading 48 against these asset classes: equities, real estate, gold, that's precious metals, gold and silver, 20-year bonds, emerging markets, world markets. So various asset classes. What's happening? We are completely losing strength. It is, if we get to a 35 or lower, this yellow is going to turn from a yellow to a red. We are very close to that happening. Now, on the 11 S&P 500 sectors, the current reading is 53. Last week's reading was 59. We are losing strength across the 11 S&P 500 sectors. We're currently yellow at 53, but the energy is going down, not going up. So I'm very concerned that these equities are just simply not going to hold up. Now we're looking at chart TNX, which is 10-year U.S. Treasury yields. Now that is the candlestick chart. In blue, we have the S&P 500, and in black, TLT 20-year bonds ETF. So what happened was absolutely amazing. The 10-year U.S. Treasury yields on last week's action skyrocketed north. I mean, just completely north. Current reading about 44, which is taking us very close to its old recent highs. I've drawn in here a trajectory line that we had from this peak over to this peak right here, and we are very, very close to that resistance line. So we could go a little bit further north and then bounce off it and then start traveling south. Now, what I want to point out here, what happens when 10-year yields go north? TLT absolutely responds heading south. What did SPY do? SPY really went sideways. And that is actually very bullish for the S&P 500, because as the yields start traveling north, that's when you can start taking your money out of the stock market or equities and putting it into some type of fixed securities, CDs, money markets, bonds, and U.S. Treasury yields, and you can start earning a decent rate of return. So when that happens and you start pulling money out of equities to make that happen, what happens to equities? Well, you're taking money out of that asset class. Well, that asset class is going to start tanking. And that asset class has held up. It hasn't tanked. But you can see how on TLT, 20-year bond yields, you can see those are absolutely respond practically on a one-to-one basis. It's totally inverse. So as this travels north, TLT just travels south, and there's no delay. It's 100% instantaneous. So that's where we stand. Now, look here at the MACD. The MACD is right at the zero line, just crossed above its signal line. Plenty of energy for that to go north. Slow stochastics above its signal line, just passing the 50% mark, traveling north. That tells me that on TNX is going to continue to travel north. TLT is going to continue to travel south. Now, SPY so far has held up and traveled sideways, but there's going to be pressure if this continues to travel north for SPY to travel south. Okay, now I want to show you this here about Warren Buffett, the Oracle of Omaha. Warren Buffett currently has $325 billion in cash, because Warren Buffett has a mindset like me. Cash is an asset class. If you don't have a good product to invest in, put your money in cash. Now, $325 billion sounds like a ton of money, but for Warren Buffett's portfolio, it's only 28% of Berkshire's asset value. So it's so basically you could summarize this. He has 28% in cash, not 100%, not 75%, just 28%. So take that $325 billion and put it into perspective on a percentage basis. So if on our $100,000 portfolio, if we're going to follow in the footsteps of Warren Buffett, not bad footsteps to be following in, we should be taking 28% off the table immediately. I'm a little bit more of a trader than he's a little bit more of an investor, long, and this guy is long term. This guy puts money in stuff and lets it grow 10, 20, 30, 40 years, and he watches those long-term assets grow. I'm a little bit more conservative or a little bit more of a trader mindset with my own trading. So I plan on going a lot more than 28% in cash. But I just wanted to kind of show you this, just to kind of show you where Warren Buffett, one of the all-time greatest stock market investors of all time, what he's doing currently. Okay, that is going to take us to the conclusion of this video. As of December 14th, 2024, the market summation, according to me, Ken, your friendly host for SPY Trader Now, the market is deteriorating under the surface, noted by the yellow on the strength signal, that yellow right there. I don't believe we have a good risk to reward ratio. I've been talking about that throughout this entire video. And my plan is to exit to cash on Monday morning, okay? And I alluded to that also earlier in the video. The asset classes and the S&P 500 sectors are losing strength. I showed you my Excel spreadsheet, how I keep track of these things. I can see this market easily pulling back 3 to 10% during the next pullback instead of moving up. And for that reason, I am wanting to close all my current positions and just sit in cash for now, okay? So currently, I just have the 200 shares of SPY. Looks like I'm going to take a bath if we close out at the current market conditions of $500, or I've lost 0.42%. I'm not really worried about that 0.42%. The portfolio, as you know, at 33.29% year to date is still an outstanding return. Let's not sweat the small stuff, okay? Now, even though I am giving you all of these opinions and telling you where I think things are at, the market is an 800-pound gorilla. And this 800-pound gorilla right here will do whatever it wants to do whenever it wants to do it. I hope you got some valuable information out of this video. If you have not done so already, I want you to smash that like button down, subscribe to my channel, and ring that bell. I thank you and wish you good trading.